As the power and influence of technology grows, the power and influence of those who create it and distribute it also grows. Many times, it now seems, when such companies or other organizations grow to a certain size and achieve a certain level of leverage, they branch out into areas not strictly covered by technology, or perhaps seek to take domains that have traditionally not been under the jurisdiction of technological industry and apply technological progress to it, not from the standpoint of the domain looking to seek out new ways to improve their processes, but rather from the standpoint of how a technology company would seek to reinvent that particular domain. One common and important domain where this is taking place is, of course, finance, the world of money. And while you could debate the pros and cons ethically and sociologically of having companies whose purpose and origin is technology now shifting to encompass a broader scope of societal needs, including such a critical one as money, the point remains that they are here. They are in that space. The bigger and broader strokes that gain the most attention are also the ones that are more risky and therefore seem to have more issues come along with them, such as the case of Facebook's Libra. Cryptocurrency itself as a whole is obviously a big influence here, but the origins of that and how it get implemented stand a bit aside from the rest of the technological aspect of finance. There are many hundreds, if not thousands, of smaller examples where technology companies seek to adapt, reinvent, or inject new processes into existing financial technologies, such as the use of artificial intelligence to predict markets or understand consumer spending habits. And many of those technologies stay on the financier side of that domain. Oftentimes we don't, as consumers, even necessarily realize that it's being implemented. Other times it's more blatant, and in some ways these are the times that we take the most notice. For instance, Google has a few months back announced a plan to offer its own checking accounts in conjunction with various banks. For consumers, this has the potential to make integrating various payment systems simpler, being able to hook in your bank account directly in Google Pay more seamlessly. For the banks themselves, it offers Google's known technological acumen. By all accounts, the actual financing controls would still be operating through the banks, but Google would provide additional analytics, data control integration, which again also provides more data insights to the consumer, but also to the bank and, of course, to Google. But given recent concerns over content control and privacy, there are also issues being raised related to that. Some time ago, there was a case where a Google account was shut down because the user had commented with emoji on a YouTube video. This had been marked as spam, and the automated measures shut down the account. I believe that particular incident got resolved later, but the point here is that the account itself got completely shut down because of this activity, and it was very, very difficult to reestablish any part of that account. Google, despite its size and the number of its employees, is often so overwhelmed by the task of content management and curation that it becomes nearly impossible for the end user to get in direct touch with someone from Google to resolve an issue. And while this may only be a minor hassle when it comes to a YouTube video or your email, it can still have significant implications if you rely on YouTube for your revenue stream or use Gmail in your business. And of course, this becomes only so much more significant if you have your bank account tied into Google via the same account. This example with Google is only one instance of a broader concern regarding how technological companies will fit into the highly sensitive space of financial technologies. We don't want to bar new advancements in technology from these areas. There is much to be gained, not only in the more obvious data insight, but in the ability of modern technologies to transform the way we live our lives. The theoretical potential of something like Facebook's Libra, however the practical realities may have come out, The potential is significant. We can't ignore how much we can stand to gain if these technologies are handled correctly, implemented well, used for the benefit of the consumer. But of course, that's not an easy thing to mediate. The financial industry is highly regulated. The companies are still looking out for themselves, but theoretically under supervisory laws that also look out for the consumer. And yet, when we hit recessions, the institutions still suffer. On a day-to-day basis, the end consumer may still suffer. So even in something as stable, relatively speaking, and significant as the existing banking institutions, there's already difficulty in managing the technologies in place. Leveraging new technologies, adapting our existing processes and laws to adjust for this, might be one of the most tricky adjustments that any technology would require. But there's no way to know if it's going to work without taking the plunge. You can draft as many laws, make as many contingency plans, put in place as much oversight as you want. But the fact of the matter is, at the end of the day, it's either in place or it isn't. We're either changing how we do things or we don't, and it either works well or it doesn't. Is it worth taking the plunge? Of course, we want to do it carefully, but if we're going to do it, we have to be okay taking the risks. This is the sort of area where we may only know whether it was a good idea in hindsight.